Hi, I'm Shawn, a business appraiser with over 20 years experience in the valuation industry, appraising privately held businesses. And I've been asked to talk a little bit about, valuation as a science and an art. What is it? And how can two different appraisers come up with different numbers, and why? Well, part of it comes down to, valuation is as much art as it is a science. And business appraisers will look at the same data and sometimes interpret it differently. The valuation world really comes down to two real levers that we can pull. There's the income the business is expected to generate over time, and the risk associated with that income being received going forward. If we're appraising a business that has been doing $1 million a year in revenues for the last several years and is expected to do something similar going forward, there's probably not a whole lot of extra risk associated with that particular business. And we can use a historical analysis and present a fairly stable growth rate and say, okay, income divided by risk equals value. Some business appraisers will think there's more risk than others. Some business appraisers won't look at the same adjustments the same way. But where things really get hairy is if we're appraising a business that's having some changes. If there's a change in the operations of the business, if there's a new client was just obtained, or they're opening up a second location, or they're seeing a new market area open up, and the expectation is that the future growth of the business may be drastically different than what it has done historically. Well, then you're looking at a discounted cash flow analysis, and that involves a multi-period forecast. So an appraiser is going to look at the expectation of future earnings and try to figure out, what kind of growth rate makes sense? And usually, when you're opening up in a new market, or you're seeing a different product launched, there's going to be some rapid growth for the first little while. First year or two, you might see stronger growth. And then absent any additional inputs, growth might taper off for a while until it gets to what's called a long-term sustainable growth rate, which is the equivalent of basically inflation or price increases plus a little bit. You might have net a few new customers every year. And the risk of achieving a multi-year forecast like that, or seeing those results as they're projected, might be higher than what you might see in a more stable type business. We might also look at transactions of other companies, see what they're selling for, and keep in mind that the transactions of other companies are usually based on what they sold for in their time period, and they're not necessarily going to reflect with the expectation of future value over in the 2 or 3 or 4 or 5 next years that we would expect to see something different happen in the forecast. So sometimes the market approach may not be as applicable in those types of analyses. But again, it comes down to judgment as well as how the facts of the analysis are presented and interpreted, and again, how they all interrelate with that risk rate. We'll talk about that in later videos, I'm sure. If you have any other questions you'd like me to talk about, send them in. I'd be happy to provide a response.